Good evening. This is Tom Alexander. It is Sunday, June 19th. Happy Father's Day to all you fathers. I am a father. I'm a father of four. Okay, we have the cash market is closed tomorrow, but we have Globex that opens in a few minutes. By the time you get this, hopefully not everything that I put in this report, everything we're going to discuss will have been erased because of Globex, but we'll see. And if it does erase it, I will send out another report prior to the cash open on Tuesday morning. We are in a waterfall decline. We are seeing some unprecedented selling. Let me show my screen. Okay, so here are the 4 daily U.S. cash trading indices. I want to start with a weekly. I put this in the report, and the decline that we have in June so far is not quite, is about 13%. And that is among the most severe monthly declines since the March 2009 low over 13 years ago. So we're getting extreme. There's 8 more days left in the month. We are in a waterfall type of decline. I don't call this a crash because it's just been a relentless downside move. The rallies have been extremely short-lived and relatively shallow so far. And the rate of change that we've seen over the past few weeks is not sustainable. But you know, we have not had that capitulation event that a lot of people have been looking for, and it's still on the table, frankly. Now, if we go to the daily indices, that's the futures contracts. I want the cash contracts. Here we go. Now, this is a potentially bullish event. We had lower lows in the S&P and the Dow. We had higher lows in the NDX and the Russell. You will almost always get divergences like this at market turns. The bad news is you'll get a lot of false signals. We've had several in the decline so far. Actually, the last rally we had a similar divergence where the Russell held up and the other 3 went to lower lows. Well, this is a minor divergence, but it is a divergence. I'm pointing it out because when you do have these turns of any relative significance, you'll almost always see that they are accompanied by divergences at the extremes among the indices. So we have that now. Now, all it takes to erase this is just further selling below Thursday's low and lower lows in the S&P and Dow, below Thursday's lows in the NDX and the Russell. So there's that. The profile view doesn't offer a whole lot. We're in vertical development to the downside. This is a distribution. Again, we're not going to continue lower at this rate of change, but there's nothing that this particular perspective, there's nothing that quote unquote market profile adds to the current analysis of the market condition we're in. There's no magic to be had from this particular perspective. What else do we want to look at? Let's look at the internals, which I think are really interesting. I'll come back to this page. Now, what has been stunning since the January high are the number of negative 2,000 days, the closing, NYSE breadth, closing negative 2,000 or greater. We've had 15 such days. We've had 4 out of the last, I think 7. I think I put it in report. This is capitulation-like selling without price capitulation, if that makes any sense. We haven't had that dramatic 3, 4, 5% down day or any limit down days. That may be coming, but if it does come, we're going to set historic extremes in this breadth stuff. The 10-day moving average of advancing issues is already extreme, seen only more extreme during the March 2020 decline. The 5-day is as extreme as it's been since the March 2020 decline. And then, of course, you see the clusters of breadth here. So this is a situation that the market is not going to continue to go down day after day with negative 2,000 breadth readings. It is going to scream higher in at least a short-term rally, or we're going to get that lock limit down day, the limit down day, and with some sort of extraordinary wide range. Of course, I've been thinking this for a couple of weeks and it hadn't happened, but I'm going to employ the stop clock method of analysis here and stick by that. This is the 10-day average true range. The blue, the red is VIX. I'm watching VIX extremely closely. VIX is actually causative in a lot of ways because of the dynamic of option pricing and the dynamic of dealer hedging option activity. And if VIX begins to drop, it could add a lot of fuel to a rally. On the other hand, VIX is also one of the indicators that has really, it's held up, it's been stubbornly high, but there hasn't been this giant explosion in breadth, VIX, like you see occasionally in short-term panic. Like the best example was back in March 2020. Now, it doesn't have to happen, but it hasn't. But for practical purposes, what I would encourage you to do next week is to keep an eye on VIX and its trend intraday, because if it begins to trend lower and the market begins to rally, it could add a lot of fuel to the rally and it could scream higher. Okay, if you found this helpful, please subscribe to the channel. Please like it, hit the notification bell. You'll be notified when I do these updates. If you have comments or questions, please post them. You guys have a wonderful rest of your weekend. And again, if Globex blows everything I said out of the water, I'll send out another update.